Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, the Guardian and the Challenger go head-to-head on 4.66% guaranteed and you still want to gamble. The cash I.S.A. is the only rational choice right now. Let's get into it.
Cash I.S.A. easy access rates are at 4.66% right now. That's a guaranteed, tax-free real return above 3% inflation. Why on earth would you gamble in equities when you can lock that in?
Because over 10 years, that safe choice costs you roughly £18,000 in missed growth compared to a diversified stocks and shares I.S.A. Over 20 years, the gap balloons past £60,000.
Those projections assume equities keep delivering historical averages. But right now, with Iran pushing oil past $100 a barrel and markets pricing in rate hikes, not cuts, you're taking on serious downside risk for that hypothetical upside.
There's always a reason not to invest. Brexit, COVID, the energy crisis, the FTSE All-Share still returned over 8% annualized through all of it.
Sure, if you held through a 20% drawdown without panic selling. Most people don't. The volatility tax is real. Behavioral losses from selling at the bottom are never captured in those neat historical charts.
That's an argument for better investor discipline, not for hiding in cash. You don't solve a behavior problem by accepting a worse asset class.
It's not a worse asset class when the real return is positive. For 0.66% minus 3% inflation gives you 1.66% real, guaranteed. No drawdowns, no sleepless nights.
And what happens when that rate gets cut? Cash rates are a teaser, they reflect today's base rate, not a decade-long commitment from your bank.
Rates might not get cut anytime soon. Markets are actually predicting hikes given the geopolitical situation. And even if rates drift down, you've banked the gains already. That's how cash works.
But your time horizon doesn't end when rates drift down. If you're saving for retirement in 20 years, a couple of good years in cash followed by 3% rates doesn't compete with equities compounding at 7 to 8%.
I'm not saying never invest in equities. I'm saying right now, for the next 12 to 24 months, the risk-reward clearly favors cash. You can always rotate into stocks later.
Timing the rotation is just market timing with extra steps. When exactly do you switch? After rates drop and stocks have already rallied 15%. You'll always find a reason to wait.
Fair point on timing, but here's something concrete. The I.S.A. allowance just got slashed to £20,000, and there's talk of further cuts. With a limited allowance, why waste it on an asset that could be down 15% by April?
That limited allowance is exactly why you should use it for stocks. The tax-free wrapper is most valuable on the highest returning asset. Sheltering 4.66% cash from tax is nice. Sheltering 8% equity growth is much better.
Only if you actually get 8%. The FTSE had a strong 2025, I'll grant you, but one good year doesn't erase sequence of returns risk for someone investing today.
The FTSE's 2025 wasn't a fluke. UK equities were trading at a massive discount to global peers. Even after the rally, the price-to-earnings ratio is below the long-term average. There's still value there.
Cheap valuations don't protect you in a crisis. If oil stays above $100 and we get stagflation, equities and bonds both get crushed. Cash is the only genuine safe haven.
But stagflation is exactly where cash gets destroyed too. If inflation jumps to 5 or 6%, your 4.66% rate is suddenly a negative real return, and equities, especially commodity-heavy UK stocks, actually keep pace.
If inflation spikes that high, the Bank of England raises rates and cash I.S.A. rates follow upward. That's the beauty of variable rate cash, it adjusts.
It adjusts with a lag, and banks pocket the spread. Look at 2022, the base rate hit 3.5% and the best easy access I.S.A.s were still paying under 3%. Banks are not your friend here.
All right, I'll concede the lag is real. But even with imperfect pass-through, you're still not losing 20% of your capital in a month. For anyone within 5 years of needing the money, cash is simply safer.
I actually agree with you there. If you need the money within 5 years, cash makes sense. But most I.S.A. savers are building long-term wealth, and for them, cash is the bigger risk.
I think that's where we partly agree. My concern is the people being told to pile into equities right now when geopolitical risk is elevated and they've got a perfectly good 4.66% sitting there.
And my concern is the people sitting in cash congratulating themselves on 4.66% while inflation quietly eats their purchasing power and compound growth passes them by.
Here's my final point. A guaranteed 1.66% real return with zero volatility is a historically unusual opportunity, and anyone ignoring it because of what stocks might do over 20 years is letting theory override common sense.
And mine is this: every generation of cash savers thought their rates were good enough, and every single one of them got outrun by equities over the long term. History doesn't whisper that lesson, it shouts it.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.